Well, the big story, teen, 2023 has to be inflation. Those prices going up.
Everybody's panicking, Norm. Everybody's saying how much more everything costs.
Don't freak out.
Do not worry. We are here to say, hopefully, it will get better.
We are Tina and Norm. We talk all things retirement, and we are not financial planners.
No,
We are not insurance experts. This video is for entertainment purposes only. Don't take financial advice from people on YouTube.
No, we are suggesting that you go and seek professional help.
We do. But everybody's going on about recession. What recession? We've had far worse, teen.
We've actually lived through two huge recessions in the time we've been married, haven't we, Norm?
We have indeed. The interest rates that
Yeah.
we had on our first couple of mortgages were nearly 20% in England. Think about that.
That's something to panic about.
But we made it happen.
Yeah.
What we want to talk about here is what our strategy has been to cope with inflation, with stocks going down. So it's almost like the perfect storm. You've got the stock market losing value, and that could be individual stocks, can be mutual funds, ETFs. They're going down. There's no clear way to say that. Your savings in your savings accounts, it's next to nothing, isn't it? We have high interest savings account, and it's 2.5%. Well,
Not exactly very high, is it?
the rate of inflation going into February 2023 is somewhere around 6%, give or take, in Canada. So our 2.5 is losing us money. So this is what we did before we retired, and we're really talking to people who are still in the workforce, still slaving away. So what we did, back in the 90s, all that long way away, we had RRSPs, which are registered retirement savings plans in Canada, kind of like a Roth IRA or a 401k. And so we were contributing, and we were doing that wealthy barber thing, saving 10% of your income.
That worked out really well, didn't it?
It really
Yeah.
did.
Yeah.
So we were saving into these mutual funds, and they were just losing money. They had a high MER, which is a management expense ratio. So they were paying themselves first from our money. And then the funds just weren't going anywhere. In fact, some were losing money. And at that point, Tina and I thought there must be a better way of tackling this. So what did we think about doing?
So we decided that we would stop paying into our RSPs and that we would take that money and pay our mortgage off faster. With the idea that we always had it planned that we would sell the house and that money would fund our retirement. So we thought this was a very clever way of getting there quicker.
And
Yeah.
it gave us a 6% return on our money, because
Yeah.
that's what our mortgage rate was in those days. We never got to that 1% or 2% mortgage rate, because our house was paid off well before the last 10 years of all this madness of low interest rates. So we were earning 6%, which was more than the mutual funds. We were working towards being debt-free. So the mortgage that we had allowed you to make additional payments. So once a year, you could say to the bank, in the early days, you could increase your payment by 10% on the anniversary date of the mortgage. And you could make a 10% lump sum payment. We never had lump sum payments. Who are we kidding?
No,
We were living paycheck to paycheck
just like everybody else, eh? Yeah, we didn't have that, did we?
And then as time evolved, the bank increased that to 20%.
But we did do that, didn't we, Norm? When it was 10 and then 20, we actually made that conscious effort to every year on our sort of anniversary, we topped it up on the most amount we were allowed to do.
So
And,
increasing the
yeah,
payment.
and boy, did it make a big,
Huge difference.
yeah, huge difference how
We had a
quickly it was
25-year
paid.
mortgage and we got it paid just under 15 years.
Yeah, made a big difference, didn't it?
And so we weren't losing money
No.
because we were getting rid of the mortgage. And so we became mortgage free. Once again, a super feeling. We had a mortgage burning party
Yes, we did, didn't
with
we?
all of our close friends.
Yeah, that was great.
And it just meant that we knew that we had an asset that would continue to grow as we lived in it. And we had all that extra cash flow. So now we could start saving for retirement again.
Yeah.
And we didn't do the mutual funds. We went direct to stocks. So we transferred all our mutual fund RRSPs to a online stock broker. And by doing that, we didn't have to sell. Well, we did have to sell the mutual funds, but transferred the money within the RRSP to the new brokerage, so it didn't attract any tax. And then we just bought stocks.
And it was also around that time, hey, Norm, when we started to fund the TFSAs.
Yep.
So whatever the yearly allowance is, I think it's 6,000 a year at the moment.
Six and a half.
6.5. So we made sure that we put that in every year too.
Every year.
So
Max it out.
yeah, that was good too.
So if you're in your 50s and you're thinking about retirement is looming on the horizon and you have debt and you're disappointed that your investments are going down, maybe transfer your payments from being in investments to debt repayment, where you would get a real return of money on that. Once again, you should go and find expert advice so they can see what your situation is and advise you based on your circumstances, not Tina Norman's circumstances.
Not based on what we did. But you know what, Norm? It was a great strategy that we came up with and we stuck to it and it paid off for us.
And it fits into this recessionary times of where inflation is starting to erode all the investments. So perhaps look at debt repayment. Might be a better return on your money. And if you're new to our channel and you haven't already, would you please consider subscribing to our channel? It really does help us find a wider YouTube audience.
And if you like what we do, please give us the thumbs up because that really helps us grow.
So we hope everybody is keeping well.
And staying safe.
And until the next time.
Bye-bye.
Bye-bye.